Well, Sanjay Mukim is our market master of the day. He's strategist head of India equity research at JP Morgan. Sanjay, it's a pleasure. Great to have you with us here. Thank you very much for your time. Your latest note is interesting. It's unconventional. You're talking about your travels to rural and semi-urban India and the findings that you have. Maybe a little bit of an unfair question to ask you to directly tell us the findings of what you saw in your travels to what the market is doing, especially on the rural side, Sanjay. Because that's been a bit of a worry, right? That at the lower end, especially on the rural side, things have been weaker, etc. Are you seeing signs that is changing? Go on.
So there are two different answers to your question. Good morning and great to be on. One, of course, is your view or the query on what rural India is doing in the near term, right? Whether you're seeing a revival of demand. Now, we'd argued in our note earlier in March that the conditions for a resurrection of mass market consumer confidence are in place. Jobs have come back post-COVID, wage inflation is higher than it used to be, and consumer confidence is looking better. The debate to have, is whether you will see that revival in demand in a 3-month period or a 6 or a 9-month period. But the note we did today actually looks at India's growth dynamics from a longer horizon. This is not a 3, 6, 9-month research piece, but to look at the fundamental changes or fundamental improvements in the broader consumer pyramid in India. And there are two sort of narratives there. One, income levels are still relatively low and it needs to continue to go up. So there's a potentially lot of upside. But when you do go and visit people and talk to people on the ground, you do realize that over a course of time, there has been significant improvement in the social safety net, in the facilities that are available to the bottom of pyramid people in India. And that underpins productivity growth, that underpins the long-term consumer outlook for India and increases assurance in long-term growth in the economy, right? And therefore, the bias there is to say that, look, if you can find companies that are exposed to it, you should have a long-term positive bias to a B2C domestic-facing consumer set in India. You just need to find the right execution set of companies in India. So on a long term, you always continue to have long bias to Indian stocks, especially those focused on the domestic economy. In the near term, you will have to wait for this revival, which also we think is actually underway.
Sanjay, morning. Just taking a look at Bajaj Finance's numbers, it's quite extraordinary that a company, that an NBFC of this size is growing at 9% AUM quarter on quarter and more than 30% on a year-on-year basis. And of course, the stock is getting rewarded today. Is this something that could be replicated by the other big banks and NBFCs in India? Maybe are we underestimating the kind of growth, the credit growth, the AUM size increase, the disbursements growth that India could see, these large banks may clock in the next 2 years?
Without referring to a single company or a stock here, our view is that system loan growth in India will actually decelerate in the coming few quarters for two big reasons. One, nominal GDP growth last year was very strong and you had inflation and WPI was high, which drove credit demand partially. And that phenomena is going to go away in the coming quarters. WPI is already negative as it is. And nominal GDP comes in at the 10-11% mark, which is the current base case today. But the second constraint that the financial system in aggregate is likely to face is a lack of deposits. Right? There is only about 10% deposit growth in the system. People have had surplus liquidity carried over for a variety of reasons, which they have redeployed into lending. But that phenomena can persist for only so much longer. So for the entire system, the credit growth momentum is likely to moderate into the low double digits to my mind. What you need to pick out is which particular financial company has the capacity and the willingness to grow faster than system. Now, historically, you've seen that the private sector banks have always gained market share and done 6 to 7% higher than system loan growth. The challenge now is that the private sector is more than 40% of total system. It's no longer a smaller component. And the PSU banks are also competitive for a variety of reasons. So it will be an interesting next few quarters to figure out how these market share changes happen and whether a large number of financials can continue to outgrow the system, which theoretically is challenging.
Right. Sanjay, just before we speak to you about your sectoral preference is keeping an eye out on a couple of these stocks where there would be pre-positioning ahead of their pre-quarter update. So Titan is up around 1.5%. Godrej Consumer is the other one which is doing well. And we're seeing some performance rise on names like Trent, retail and consumer discretionary, Jubilant Food, which was one of Sudarshan's calls, doing extremely well as well at the high point of trade. Sanjay, you were a naysayer on IT for the longest time, and that's worked out extremely well for you. The Nasdaq is up 32%. Everyone's talking about artificial intelligence and that reducing the cost for a lot of these IT players and impacting their margins. Do you think the time to buy IT has just been delayed further?
Yes, so we are in the camp that it's a bit too early to look at Indian IT companies on the basis of their correction or on the basis of a valuation anchor or any of that sort, because we expect many of these companies to come in with numbers weaker than expectation in this or the next quarter. And some of the mid caps or smaller names are also trading at very elevated valuations as well. So you're likely to see earnings misses, downgrades, and valuations again are not at supportive levels to our mind. There may be these technicals, people keep talking to me as well, oh, Nasdaq's going up and tech's rallying and all, but I those things don't matter. If companies miss earnings, then the stocks will remain under pressure to our mind. Now, at some point, you may be able to make a call that, the demand momentum globally is bottoming and there are possible signs of a revival in IT demand. I think that it is too early to make that call just yet.
Got that. Although, you have a very broad perspective, Sanjay, because of your global coverage as well. The expected weakening in global demand, especially US demand, is just not happening, right? And people have been waiting for it for at least a year. Rates have gone up 500 basis points and data is just coming in strong. Maybe once in a while you get something which indicates some softening, but nothing large. By and large, still strong. So in that light, Sanjay, I mean, how does that, do we need to reassess it's, as we get into the second half of this year about what we thought this year would be like at the beginning, especially with the export-oriented sectors like IT?
So yes and no. So we are seeing feedback from companies that consume IT services that their approach to spending growth has turned very conservative, right? Now there are two sort of narratives. One is what is happening to the economy and whether the consumer is slowing down. There are signs that there is some slowdown, maybe not as rapidly as you would have expected, but the direction is softening a little bit. On growth, on consumption and so on. But the feedback from people, the large companies, the BFSI, retail, is still very cautious. So we still expect that the IT universe growth of demand will come in weaker than people's current forecasts, right? So that remains a concern for us. The bigger question to your point is, look, if the economies don't slow fast enough, then the Fed will not have the reason or opportunity to cut rates and reverse its QT, in which case there is a significant gap in equity valuations. If the current liquidity tightness continues and liquidity withdrawal continues and rates remain high, equities are mispriced, and then this rally may turn out to have been very premature.
All right, got that. Thank you very much, Sanjay. Appreciate you joining in, and it's a pleasure having you with us here as always. Thanks indeed.